Welcome to America's Commercial Real Estate Show, your source for market intel, forecasts, and strategies. Hello, I am Michael Bull. Thank you for being with us. This segment is brought to you by my company, Bull Realty. For customized asset and occupancy solutions, visit bullrealty.com. Well, we're continuing our coverage on Corona time, coverage of COVID-19 and the impact on the current commercial real estate market. We're also covering how commercial real estate participants are dealing with this situation and what to expect moving forward. Please welcome my guest. It's Brian Bailey. He is a CCIM, he's a CRE, and he's the Federal Reserve's commercial real estate subject matter expert, and he's joining us on Zoom today. Brian, thanks for joining us, sir.
Michael, you're looking well. Thank you for having me back today.
Hey, we all want to be well right now, right? We're all, here we are, it's May 21st, and things are kind of starting to open back up, and I think a lot of people are curious out there as kind of what's going on in the market, and being with the Fed and the commercial real estate expert for the Fed. I think the first thing I'd like to ask you is really about defaults on commercial real estate loans right now. Kind of what do you see so far?
Great. Well, I appreciate the opportunity to come back. I think, this has been year 4, year 5 now that you've had me back. So thank you so much. Today, I appreciate the opportunity to share, a few thoughts with your audience. Certainly, these are my views and not necessarily those of my colleagues at the Federal Reserve Bank of Atlanta, nor the Board of Governors. Defaults today, certainly we are in unprecedented times. You look at, how commercial real estate has been impacted, retail, hotels, office space, with, the shelter-in-place orders. And you would think that defaults, were astronomical, at an astronomical number at this point in time. But really, the market has performed very well. It's surpassed a number of participants' expectations. Rent collections outside of hotels, obviously, have really exceeded most of the people that I've talked to in the last 2 months. So certainly, good dynamics there. It is beginning to tail off a little bit. So we had, roughly 90+% collections across multifamily, across office, across industrial in April and again in May. Certainly retail faced a number of headwinds already, and collections are roughly about 50% for both of those months. And so certainly, beginning to see, some of the defaults beginning to tick up a little bit in the CMBS space. I mean, we've seen delinquencies rise from 1.3% in April to roughly 5.6%, give or take, in May. There's still, 10 days left, so you may still see some payments. I think a lot of that, obviously driven by the stay-at-home orders for hotels, driven to the same degree with retail. Obviously, retail was already impacted by the stay-at-home orders. On the other side, looking at the regulated lending community, I know that a number of banks right now have taken some of the guidance, and there's been a significant amount of guidance that's come out of Washington as far as how to handle, issues with COVID-19 today. And so a number of lenders have capitalized on that guidance, and they are working with their borrowers today, as is the expectation from the regulators. The regulators are expecting that if, in 2019, at the end of 2019, if a borrower was in good standing, we expect the bank to work with them. Our president yesterday, our president, Raphael Bostic, the president of the Atlanta Fed, said yesterday in a Nashville speech that, we certainly are encouraging and expecting the banks to work with their borrowers where safety and soundness, is in place. And we will certainly remember the institutions that have heeded that mandate. So certainly our expectation is that the banks will work with their lenders that were in good standing.
That's very good to hear. So those loans for these banks won't put those loans in a bad box. They won't have to increase their reserves right now for loans that maybe they've deferred payments on.
Well, there's been a specific guidance that's targeted that. So temporarily, we have relaxed the guidance associated with TDRs, which are and this was actually driven by specific legislation in the CARES Act, and that legislation, mandated under certain circumstances that lenders could and were expected to work with their borrowers. And so in a lot of instances with these temporary debt restructurings, that regulation has been relaxed, and a number of banks are taking advantage of that dynamic to structure and restructure some of the payments to better suit today's climates required by the business community.
And that's still up to the bank itself, right, to make those decisions and how to do them, right?
That's correct. Yes.
Yeah. And how long of a period at the moment, again, here we are, May 21st, might deferrals from a bank to their borrower be considered, not a default for the lender to put those loans in the bad box that they've got to add to their reserves? Is that 3 months? Is that 6 months? Or does that depend?
Well, I think it's really dependent on what the lender sees right now. So the lender has the decision in this instance. I think that certainly lenders are taking into account the current environment and working very hard with the borrowers, but it's really dependent on the specific circumstances.
Yeah. And I think a lot of people are trying to figure out, hey, what's the future look like? And it's there are some unknowns, but we did go through a recession that was manifested in 08 and 09 time period. So if we look at banks, for example, and how they were situated back in 08 and 09 financially, and how they're situated, especially related to commercial real estate loans today, is there any difference there? Are they in a better shape potentially than they were to maybe handle a storm?
Yes, by far and away, head and shoulders, the banks are in a much better capital position today compared to the late 2000s. So certainly, I think that is very beneficial. It is certainly helping with working with the flexibility needed in today's environment associated with COVID-19, because we are in a dynamic that's really driven by the timeline associated with the health science piece with the virus. And so the expectation you've heard out of a number of the policymakers out of the Fed in Washington or at the Atlanta Fed is we're dependent on that timeline. But the expectation is once we figure that out, that a number of the pieces are in place for a pretty significant rebound. And so certainly, the banks being in a much better capitalized position is certainly checks a significant box as they continue to lend. I think the other thing is that we know that there was a lot of work that was required on behalf of the banks. Coming out, stemming from the Dodd-Frank legislation, and the banks that have gone through, those mental gymnastics, and worked hard to better understand their business, driven by the requirements from Dodd-Frank, are in a much better position because of that intellectual exercise. I mean, they understood their customers, the customers' businesses, and they understood the associated risks. And so as we look across a number of the institutions today, they are saying, hey, we have the systems in place to be able to tell you, what's our retail exposure? What's our exposure to the industrial sector? What's our exposure to hospitality? Where are those properties located? And so certainly, that is a significant improvement over where we were in the mid 2000s. So I think that head and shoulders today, the banks have a better capital position. They've got a significant better analytical suite. And so we are in a better position. They are in a better position, today compared to the mid 2000s.
And that's good to hear too, because, if they quit just doing loans on commercial real estate, obviously that starts hurting values, and this becomes a huge circle there. And as we try to compare, the last recession to what may be ahead of us, let's look at the borrowers kind of out there in their situation right now. When you look at the overall debt on commercial real estate compared to commercial real estate values, you kind of look at the loan to value ratios. Where are we compared to 08, 09 and today? Or do we have less debt on these properties than we did back then?
Yeah, so definitely night and day. As far as LTVs at the beginning of the great financial recession versus the beginning of the downturn associated with COVID-19. You look to the CMBS market. A lot of instances, I think the average for CMBS was in the high 80s. And we know that that may not have been a fully accurate representation of what that number was. And it probably was realistically somewhere in the 90s. So, very little margin of error back in the mid 2000s. And we obviously, felt that dynamic during the great financial recession. We look at it today, I think that the average, is right around, low 60s, 60 to 62% for CMBS. So certainly there is, more margin of error. I think also coming out of the Great Recession, a number of banks were very careful with how much debt, the LTVs on these properties. They, watched it pretty carefully. Didn't see a lot of, the 90 or 100% of construction cost financing that we know went into a significant amount of trouble. And so I think, the banks generally were more engaged on managing and understanding the risk. At the same point, we saw a change in the overall lending dynamic, the lending market. And so where prior to the great financial recession, banks, CMBS, life cos were the drivers. In addition to those, we've had the rise of the non-bank entities over the last 7 or 8 years. And I think that, a lot of the non-bank entities, took some of that risk away from CMBS, took some of that risk away from the banks. And so certainly in my mind, there may be, greater, there may be less margin of error in, the non-bank lending space than there is in the bank lending space. So I think that, LTVs certainly are, different, much more conservative at the beginning of, the dynamic associated with COVID-19.
Yeah, and that should sure make a difference this time around if we're headed for a recession. And are we in or headed for a recession?
Well, I think that there's a number of thoughts, but certainly it looks that GDP growth is going to be severely contracted during the upcoming quarter. Certainly, there is a very strong fiscal support package. There has been a very strong response from the Fed as far as reducing impediments to lending, dropping rates to zero, between 0 and 25 basis points. purchasing assets, creating a number of programs for borrowers. So certainly, the expectation is that a number of policymakers have talked about a pretty bleak result economically in the next quarter, but then they're expecting that there's going to be a rebound as we begin to emerge from the shelter-in-place orders later this year. So this third and fourth quarter, I think, have more positive hope.
Yeah, that's excellent. And when we start to look at more of the differences between kind of today than where we were and say '08. We have lower interest rates today, right? As you mentioned, I guess we have really more kind of consumer savings. Are those aspects that could really help this downturn, if you will, come out of it faster? Maybe prices and values rebound faster. I know there are some other differences that you think are significant that could make this different than '08.
Well, I think this will certainly have, and already has had, a different set of circumstances than what we saw in 2009. I mean, 2009 we had kind of a steady drop off, and in this dynamic, we've had the shelter-in-place order, which certainly has created a very sharp turn as far as the economy is concerned. So already off to significant different paths. I think that there is more capital available today than there was in 2009, and so I think from a rebound perspective, certainly there is that's certainly a significant pro. I think additionally, Congress has moved very quickly on the fiscal package. It's been sizable. And so from that standpoint, that is also different than what we saw in 2009. So certainly, another check in the pro column. And then I think, the Fed has moved, at much faster rate and to a much greater degree than we did during the last downturn. So certainly, I think that you're beginning to see, a number of checks in the pro in the pro rebound column. I think the question really comes back to what is the timeline associated with the virus? How long does it take the health professionals to figure it out? And really that in my mind is one of the most major missing components for the economy beginning to rebound.
Yeah, that's certainly the wild card, isn't it? And yeah, that is interesting. There is a lot more dry powder. I remember being at the ICSC Recon convention in '09 in the spring, and everyone kind of hiding in their booths. And if anybody came out, it was like, oh, do you have any money, any equity? Everybody looking for equity. And it is totally different now in that regard. And I guess another difference, tell me if the significance here is, home values were obviously devastated at that point, and now it seems like home values have kind of really held their own. Is that what you see out there, and is that a material difference as well?
I mean, so far, my understanding is that the home market continues to function, continues to function within expected parameters. So I think with money being available, with lending continuing to go on, certainly those are very positive dynamics with the Fed and the other regulators rolling back some of the regulation and removing impediments for bank lending. That certainly is another very positive dynamic. And so I think that it is certainly a different set of circumstances today than we had in 2008, 2009. So that certainly is some it bodes well for a rebound, I think.
Yeah, and that's certainly good to hear. Well, Brian, what would you leave our commercial real estate audience with around the country to think about moving forward here as of May 21st?
Well, I think, certainly there have been some questions about, is lending still going on? And I can answer that yes, I'm aware that the banks are still open for business and they are still lending. For the most part, they've pulled back on the areas that you typically pull back on this part in the cycle. I mean, you pull back on the lending associated with speculative projects, and I think for the most part, most of the banking community has pulled back, but they continue to remain engaged fully on loans that have already been made, loans that are on stabilized properties. And so I think that's certainly a good dynamic. We continue to watch the market and monitor it closely. And as Chair Powell has said, we're prepared to move very quickly if we feel that we need to move. And so we continue to monitor the markets very closely.
All right, Brian. Well, thanks for what you do, and thanks for being on the show with us.
Thank you, Michael. I appreciate the time today.
And thank you for joining us around the country. Let us know what you think. We appreciate hearing from you, and we appreciate you sharing the show. So check us out on your favorite social media sites. We'll continue our Corona time, as I'm calling it, coverage to see how commercial real estate participants are dealing with it and what to expect next. So keep joining us, visiting our website, cresshow.com. Please subscribe wherever you're catching the show so you don't miss a show of special value to you. Until the next show, be sure you always lead, learn, and laugh, and join us for America's Commercial Real Estate Show. Appreciate the show? Consider referring business or doing business with our sponsors. Bull Realty is a commercial real estate sales, leasing, and advisory firm doing business throughout the Southeast, headquartered in Atlanta. Visit bullrealty.com for more information. Commercial Agent Success Strategies provides video training for commercial agents. This training gets 5-star reviews from even the most experienced brokers. Learn more at commercialagentsuccess.com. You're invited to connect with us on your favorite social media. You can find us on LinkedIn, Facebook, and Twitter. Don't miss a show of special interest to you. Be sure and subscribe to the show on YouTube and Apple Podcasts. And at the show website, creshow.com, you can subscribe for a weekly email announcing the show topic and guest. While you're there, you also found more videos and podcasts. Thank you for watching or listening to America's Commercial Real Estate Show.